Well, I guess we might as well get started.
Hi everyone, and welcome to the first in a series of online events that we are hosting for overseas managers that are interested in capital raising in Europe. Whilst today's discussion was originally intended for US managers, I'm pleased to say that today we are joined by a number of fund managers from various different countries, including from Europe. So thank you all for coming today. My name is Samantha Taylor, and I'm a research analyst here at IFI Global. So, an important part of my role is to really understand what US and other overseas managers are doing in Europe in terms of their selection of service providers, mancos, fund domiciles, and so forth. To that end, we are currently conducting a research study for that purpose. I'd briefly just like to say thank you for those of you who have already participated in our study. And I'd also just like to say that we'd really love to get the views of those of you who would be interested in sharing their views on this topic. We'll be hosting an online event at the end of June to discuss our findings for this. And it is also possible that we may be doing this at one of our in-person events in New York, should we be able to coordinate timings for this. Now, back to today, we'll be having a Q&A session at the end, so please do send in any questions that you may have, and we'll be sure to discuss them. So I will now hand you over to Simon Osborne.
Thank you very much indeed, Samantha. As Samantha says, my name is Simon Osborne. I am the CEO of IFI Global. I believe there are quite a lot of people joining us today around the world who don't know who we are, so I should just mention that we are a research and media house based in the City of London. We have 3 monthly publications and 1 weekly, and one of our monthly publications is called FSI, which specializes in providing information for US managers who are coming to Europe, amongst other things that it covers. On our research side, we do work helping overseas managers understand Europe, and also work with European entities, helping them to understand what US managers want. As Samantha says, we are doing a study at the moment, a very important study from our point of view, to help launch our Atlantic Fund Intelligence Unit. And that is field work we're doing primarily with US managers on their partner selection decision-making if they are looking to come to Europe. This event today is very much the first in a very substantial series of events we are going to be hosting for the remaining months of this year for US managers, now that we have launched our Atlantic Fund Intelligence Unit. And as Samantha mentioned, we hope to be doing at least some of these in person in New York. We do typically about 3 events a year in the States, and we'll be doing at least that number this year as well. And one we hope will be covering the kind of topics that we're going to be discussing today. By the way, Atlantic Fund Intelligence, or AFI as abbreviated we call it, is a service really to help overseas managers, not just US managers, but primarily US managers, who want to come to Europe with advice on partner selection, being service providers, third-party management companies, commonly called mancos, fund directors, and so on and so forth. We also give advice on legal structures that can be selected, the distribution alternatives to managers, and the fund domiciliation options that are available to them. By the way, it is a free service to our corporate subscribers. Samantha, can I have the first slide, please?
Here we go.
So what we are going to be covering today, I'm going to make some fairly broad brush introductory comments about the European markets. And then I'm going to talk about why allocations from Europe to the US are growing at the moment, and why we very much expect they will continue to do so. And then we are going to bring on Lavin Chandra, who's the CEO of PropTech, which uses AI to help managers find investors. He's going to be talking about the strategies European investors are looking for at the moment. And then I'm going to take over and spend a little time talking about partner selection advice, and finally giving you some advice based upon experience on avoiding expensive mistakes that some people have made. And we do have a lot of experience in this field. I think one of my favorite quotes is from Oscar Wilde: "Experience is the name you give to your mistakes." So I'd like to transfer some of the experience we've gained on that and share the benefits of that for some of the managers following us today. So let me, as I say, I'm going to start with some very broad brush stuff on Europe and what it is, for those of you who aren't that familiar with it. The first thing to say about Europe is that it is not in any single way a single market like the US is. People talk about the European single market, but that is something very different. Of course, there is the EU and non-EU split, but there are also big differences in investor behavior amongst the different countries that make up the EU, let alone the ones that are outside it. The Northern European states, for example, have highly sophisticated pension funds who were amongst the very first in the world to invest in hedge funds in private equity back in the 1990s and the early 2000s. ABP, TGGM, for example, in the Netherlands were in that category. The AP series in Sweden, very much in that category as well. And there were many other trailblazers back then, and others have followed them since. But then in Southern Europe, that's a very different kettle of fish, very different types of markets for reasons in future of these discussions that we will get into. And I should just add that Germany always has been and probably always will be a law unto itself. Meanwhile, the two largest markets for traditional alternatives in Europe, the UK and Switzerland, aren't in the EU at all. And when I say traditional alternatives, I mean private equity and hedge funds. In Europe, at least, real estate is now grouped in under the AIFM directive as an alternative, as are some very mainstream other strategies. So I'm not necessarily talking about them, but the traditional alternative strategies have always been led by the UK and Switzerland. The UK and Switzerland are also very large in the private banking world globally and the high net worth markets. Again, the UK and Switzerland have led in many ways allocations to that around the world over the last few decades. They manage money on behalf of a lot of Middle Eastern clients, and at least until the war in Ukraine and in London, a lot of Russian money was managed in London as well. Anyway, the point is that Europe is patchwork quilt of different markets, different cultures, different traditions, different languages. There are at least 21 different languages spoken in the European region. And despite the best efforts of the European Commission in Brussels to impose pan-European regulations on this broad patchwork quilt, it remains very much a series of local markets and therefore nothing like the US. I was talking to Lavin the other day, moving on to the subject of allocations and the growth of allocations to the US from the European region. He and I were discussing how big this is, and we were talking about the fact that there is an estimated 48%, which is an astonishingly high figure, of all European investor allocations are going into US markets in one form or another. By the way, I came across an absolutely fascinating statistic just the other day. The US equities are now worth 187% of US GDP, and the rest of the world's equities are worth just 61% of global GDP ex the US, which is a remarkable distinction, but kind of in part makes the point I'm trying to make. That there's two reasons for that. One is that, of course, the Americans are very big equity investors, but also it shows that the rest of the world is more interested in investing in the US than perhaps many people would suppose. And why is that? I think that, I mean, when you look at Europe, the prospects for its economies over the next few years, they are not good. Let's take Germany, Europe's biggest market, Europe's biggest economy. It's going through a mild recession at the moment, but that isn't its chief problem. There's been a lot of commentary on this, but the German economy looks ill-suited for the challenges of the 21st century. It is almost certain that German investors will want to allocate more to the US and to other non-European markets than they have done in the past. And Germany is a very wealthy country, so they've got the resources to do that. France, the EU's second biggest market, it could be facing a debt crisis before long and is certainly in no position to take on the locomotive role that the German economy has played in the European region. France's budget deficit is running at a much higher rate than was forecast at the beginning of the year and may end 2024 at 7% or higher without corrective action that the government doesn't appear to be likely to take. Its debt to GDP ratio is 110% and rising. It's got the third largest debt in the world after the US and Japan. Italy, the third biggest economy in the EU, has a debt to GDP ratio of 140%. And this is an astonishing figure. Its GDP per head has really not gone up in all the years that the euro has been in existence. So again, don't count on Italy for any particular economic breakthrough there either. So those are the largest three economies in the EU. Then there's the UK, which is generally considered the second biggest economy in the European region. It is also suffering from sluggish growth, and there is a lot of economic pessimism in this country at the moment. There's almost daily coverage in the media on how much better the US is performing, both in terms of its GDP growth and its markets. We publish, I said we have 3 monthly publications and a weekly. Our weekly is a macroeconomic summary of what's gone on in the last 7 days. And looking at the coverage we've been publishing in that over quite a long period now, there are no signs that the European economies in plural are going to be doing any better in the foreseeable future. And indeed, things could even go from bad to worse. So generally speaking, this is not a good place to invest by comparison with the US. Of course, there are some exceptions, and biotech in the UK, etc., and very featured areas like that are doing well, and so on and so forth. It's not all blanket pessimism, but nonetheless, as a broad brush statement, it's correct to say the opportunities for European investors often to have sizable resources from the pension funds to other institutional areas of the market, right through to retail investors. They do have resources, but they are not necessarily going to be allocating more than they necessarily have to their local markets. And I think at this particular point, this will be a very good moment to bring in Larvin Alexandra. Sorry, Samantha, if you could bring Larvin up onto the screen. And whilst you're doing that, I will give him a slightly fuller introduction than I've already done. PropTech was launched in 2018. And Larvin, I think you were saying a little bit earlier that it was recently restructured with the involvement of the University of Oxford, where he was, I think Larvin was also an undergraduate some time ago. And as I mentioned, but worth emphasizing, PropTech uses AI to help managers find investors, not just here in Europe, but I think around the world. I'm correct in saying, Larvin. So over to you. What do you see as the strategies of most interest to European investors from your point of view?
Yeah, thank you, Simon. Yeah, so when you think about asset managers from the US, our clients are alternative asset managers. I would say around 75% of our clients are from the US who want to raise capital from the European markets. And the first thing what we do is we try to identify the target investor group and try to raise capital from European and Middle Eastern investors for their funds or direct deals. And it is quite important to understand the key data of those investors. So we at PropTech.am.ai have data of about 1,500 family offices in Europe, 5,000 family offices globally, including Europe, 9,000 institutional investors like pension funds, endowment, insurance companies in Europe, and 32,500 institutional investors globally. So overall, we have more than 65,000 investors or individuals working in those investment houses and have up to 150 data points, which accumulates or adds up to 9.75 million data points. And on top of this, we have around 800 close relationships with investors from where we are receiving qualitative information on top of the data-driven information in terms of their investment preference and investment profiles. Now, in order to answer your questions, let's start with what European investors think about the current macroeconomic environment. The current market conditions are characterized mainly by higher interest rates, high inflation, and geopolitical uncertainties. And these are pushing investors towards seemingly safer asset classes and geographies. Nevertheless, our investors do not want to give up on returns and anticipate target returns between 8 to 12%, depending on the asset class and geography. The average should be around 10 to 11%. Private debt, for example, and unlisted energy-related infrastructure are examples of asset classes where we see an increased demand. The main reasons are the following. So unlisted infrastructure and private debt are examples of asset classes which can provide higher yield, attracting investors seeking higher returns. According to Preqin, the expected growth rate or CAGR is 10.8% for the AUM, which is leading up to December 2027, which means nearly 11% is the growth rate every year until 2027 for the assets under management for those asset classes. Investors are looking for stable cash flows, which are quite important. This stability is appealing to investors, particularly those with long-term liabilities like pension funds and insurance companies. Cash flowing assets are often a key preference of European and in particular Middle Eastern family offices, some of which have indicated this is a key requirement for them to invest into a US investment opportunity. The trend reflects a growing preference for resilient investments that offer stable returns in I would say, a rather volatile market. Alternative asset classes can offer investment opportunities that are generally less correlated with the broader market movements and traditional asset classes such as public equities and bonds. And this diversification can help reduce the overall portfolio volatility and improve risk-adjusted returns. From a microeconomic point of view, in 2024, around 60% of our LPs or investors started to see private equity, venture capital, and real estate are actually recovering. It was different in 2023. Investors were quite pessimistic in the short term, but are slightly more positive on a long-term basis. This is mainly because of the general market view regarding valuation. Funds with vintages pre-2023 will have probably invested at much higher valuation. In contrary, our European investors are expecting great opportunities in the medium term as we begin to see asset price reduction as a result of growing interest rates, reduction in terms of competition for deals in that space. And for this reason, we believe 2023 and 2024 might prove to be a very, very attractive vintage year for those asset classes. And this is what the investors see, and this is what the investors are also asking us to provide to them in terms of investment opportunities. Also, 90% of our institutional investors indicated that they will increase or maintain their allocation towards alternatives in 2024. We believe more that they are going to increase it even further. And now let's speak about the long-term industry outlook, which is, in my opinion, very positive. The long-term industry outlook for alternatives is extremely positive. Allocations towards alternative assets have increased drastically, increasing from 1 to 2% of overall allocation in the 1980s to a projected $23.3 trillion in AUM by 2027, according to Preqin. And this trend is something which we have also seen and discussed with our family offices in Europe. Our family offices, as you already mentioned, Simon, are allocating up to 48% into alternative asset classes. The trend is increasing. In terms of funds which have been raised, we have reached a peak of nearly $1.6 trillion globally in 2021. In 2023, this number was much lower at around $1.1 trillion. But in the next 5 years, we're expecting capital raising to reach again the $1.6 trillion mark. Even the asset classes that are not seen in such a positive light, like real estate, private equity, and venture capital in particular, are still expected to increase their assets under management AUM on a long-term basis. If we are now thinking about North America, European investors continue to invest into North America. It's such a huge market. Around 48% of our family offices had an allocation towards North America. Globally, this number is even higher, which is nearly 50% of all allocations are in the US or in Canada. Around 1/3 of our family offices want to increase their allocation, and 2/3 indicated their investments in that region would stay at least the same, and they won't reduce it. One of our investors, a family office in London, said even that they invest 100% of their capital only into the US. So you can feel how important the US market is for us Europeans. So what does this all mean in order to raise capital in Europe? In 2024, European LPs are looking for safer asset classes and geographies. Try to capitalize on the current market situation, so investors can be deployed in 2025 into real estate, private equity, and venture capital. Try to raise capital from European family offices in 2024 because they are a bit more flexible than the pension funds, and start the capital raising process right now, so that you can start to do due diligence this year and probably finish it up next year, so we can also get bigger tickets from those institutional investors. And finally, try to adapt an AI-driven and data-driven approach in order to identify the right country and type of investors. And as you mentioned, there are 21 different languages in Europe, so it can become very cumbersome. But if you have the right data, if you have the right AI, it will help you to find the right investor.
Thank you very, very much indeed, Narvin, for that incredibly impressive and broad summary of the situation. A couple of questions, if I may, on the back of that. One of them is that in the report you sent me before we have this discussion today, you said in your report that investors are putting more emphasis on niche strategies and local knowledge. Can you expand on that and say what you meant by that?
Yeah, let me give you an example. So one of our UK-based family offices also highlighted the enhanced appeal of niche and locally focused strategies. The trend is driven by the conviction that specialized knowledge and focused strategies can deliver superior returns. This is particularly evident in real estate, where family offices with investments in this sector tend to favor domestic opportunities where local insights are crucial. When investing internationally, they typically collaborate with local sponsors or invest through funds managed by third parties with local expertise. So if you're based in the States, somewhere, let's say in Texas, and you have the local knowledge over there, that family office from London will give you the money because you have the expertise which they do not have.
Right. And you mentioned in your commentary the quite substantial size of your contacts in the family office market. Can you just give us an indication, where do you think overall and particularly European family offices are going as a broad brush in terms of strategy development over the next few years? We haven't touched upon today sustainability or ESG, but there's always a lot. And we, by the way, Samantha has been doing some work on that for us. We have a sustainable investment publication where we're about to publish a report on where family offices are going, increases across the board into the different sustainable sectors. But I'd be interested in your views on that.
Yeah, you were just basically reading my mind. ESG and impact-related investments are driven by the Nordics and the family offices. Our company just became member of the UN PRI, so United Nations Principle for Responsible Investment, which is an association focusing on responsible investment. The Europeans want to make it happen. The Nordics are leading this globally. The family office principals are asking themselves, I've made so much money, so what am I supposed to do now? I can invest my money, give it to charities, or I can make the world a better place. If they do not think about this, their children are the ones who are asking their fathers and mothers whether they are investing in ESG and impact-driven investment opportunities. And that is the reason why they are driving this trend. I don't know if you have it in the US as well, but in Europe, there's quite a lot of protest going on in terms of climate change, and everybody can see this. So these people are very, very effective. And we have, for example, onboarded 2 new clients, one from Canada, one from the UK, who are focusing on investing into startups as a VC, who are reducing carbon emissions. And there's a huge demand for that. Now, when you think about the States and North America, they are already doing the right thing. So if you're thinking about real estate investors within the value-added sector or even opportunistic sector, they might replace the old radiators with new radiators, and this is reducing carbon emissions, but they do not know how to track it. Now, there are a lot of tech-related solutions which the Americans actually have to start using, because they will bring you away from an Excel-driven approach. Instead, everything will be more AI-driven, where you do not have to put in so much information because the AI can calculate the right information out of that. So ESG and impact is a huge trend. And then, as I mentioned, private debt, unlisted infrastructure, and infrastructure, again, related to energy, because the whole world had seen an energy crisis, and a lot of the infrastructure managers are focusing on that trend. Then, as I mentioned, yield is quite important because we have higher interest rates now. Stable cash flows can be very attractive. Diversification, inflation hedging, and focus on the growth market. Finally, when we are speaking about new relationships with family offices or institutional investors, the asset managers from the US should focus on technology. They should focus on reporting with the latest technology, and not creating a report on Excel or PDF and then send it out to all of your investors. Let it run through a data-driven platform where the underlying LP or investor do not have to do so much work. Instead, they're receiving the information at the right time, can always exit it by logging into a platform and receive the results.
Excellent. Before we let you go, if you can do this answer very quickly, I'm going to ask you a very unfair question. If I was going to put a gun to your head, you have to say what will be the 2 or 3 most the strategies coming from European investors in terms of what you know, in terms of increases in allocations over the next 2 or 3 years. What would you say?
So at the moment, debt is quite hot, but I can see more and more real estate asset managers focusing on the discounted assets. Private equity will remain hot as well.
Thank you very much, Loven. It's been a great pleasure to have you here today, and hopefully we'll have you back in the very near future. Samantha, if you can put some Loven back into the audience, and I'm going to now start talking about partner selection. If you can bring the slide up with the Mancos on, that would be much appreciated. I'll wait until you've got that there.
It's just
That's the
loading.
next one along, I think.
There we go.
Right, excellent. So this is now the section we're going to go into in terms of partner selection advice and trying to avoid expensive mistakes that we've seen over the years some managers have made without naming names. It is very important that managers coming to Europe really do take time to examine the options available to them before they select a service provider, a third-party management company, abbreviated term ManCo, a non-executive director, for example, for their fund board, or indeed a fund jurisdiction. And we can provide shortlists, very much tailored shortlists. There's no two shortlists are going to be necessarily the same. It depends on what the manager is looking for and their objectives. And we will never tell anyone they should pick company X over company Y. That's always the manager's decision. We'll just give them a short list of companies that they should, we would recommend that they should talk to. It's really worth emphasizing this point. I don't think it's made often enough that it is very difficult and expensive to change partners once they are selected. I remember one manager once said he found it easier to get divorced than to change his service provider. Hopefully that's an exaggeration, but it isn't easy, believe me. And more on a positive perspective, a good manager can play a really important part, perhaps an undervalued part, in the overall success of the fund. In our view, many US managers tend to go with recommendations from their lawyers or perhaps one or two other contacts they've had, and they don't put in the time to investigate partner selection in the detail that we believe that they should. In the brief time that we have today, I'm going to touch upon, as I say, the ManCos, service providers, domiciles, and fund directors. In all these areas, in future events in this series, we're going to go into these topics in more detail. And indeed, they are things we write about all the time in FSI anyway. And in terms of the ManCos, we've been publishing an annual ManCo guide for 7 or 8 years now. I've lost count and been covering the subject before that, ever since the AIFM directive came into being, which is, what, 10 or 11, 12 years ago now. So the most important thing to say about the ManCos, some of them on the screen, many, particularly the larger ones, and some of the other ones that aren't on the screen, is that there's been the most extraordinarily large amount of M&A activity that's taken place over here in Europe over the last few years. It was driven to a large extent by the recent PE boom. The biggest, or several of the biggest ManCos, are owned by private equity houses, and they're in a combination, an accumulation of several other firms that were standalone until a few years ago. So any private equity managers following us today, the first thing I would say to them is make sure that the ManCo they're talking to and they're thinking about using isn't owned by one of their competitors. It's also worth finding out who will be, when you're doing your due diligence, who is actually going to be doing the work on your account and how long they have been there. Because as well as the massive wave of M&A, there's been a lot of, and I mean a lot of, staff turnover, especially in Dublin, but also to a fair degree in Luxembourg too, which is where all these major mancos are based, and indeed where the service providers for EU domicile funds frequently are based too. And that is worth investigating. Are you talking to manco or a service provider that, you know, the person there was working somewhere else 6 months ago and will be working somewhere else in another 6 months? As I say, that's not something that tends to be mentioned enough when people are looking at doing their due diligence. And the same points I'm making about the mancos can also be made very much at the service providers. Before I go on to the subject of service providers, I should just mention these figures are figures we collected for our last annual Manco Guide, which was published at the end of last year. So some of these figures will be up to date. And the reason we have the two different currencies, some people gave us their figures in dollars and some in euros. So that hopefully explains that. Back to service providers. Of course, in the last few years, there's been, on more than a few years now, many years, there's been widespread consolidation in that market too. And it's very much become a commodity service with many service providers using the same systems as their competitors. And so it's all about basically selecting the service provider with the best price for you. However, then there is a very important caveat to this, is if you are a manager looking at doing something in sustainability or indeed in digital asset management, that is a different matter altogether. Even if you're not doing it today, if you think you might be doing it in the foreseeable future, that is it's well worth coming to us and talking to us at that particular point, because not many, in fact, very few indeed, of the major service providers or even smaller service providers have expertise in sustainability investing or in digital investing either. And I believe very strongly in both cases, digital through tokenization, especially where we're publishing now a regular section in our publication FSI on that. And indeed in sustainability, there's going to be very significant growth in the next few years. So if you're a manager who is looking to get into those categories, you do really need to think about it when you are looking to hire a service provider, and not just here in Europe, but in the States too. To repeat, we're going to be doing a fuller session on the subject of service providers and mancos in the not too distant future. Samantha, can I have the next slide, please?
Yep.
So the last two areas I'm going to touch upon today, and then we're going to go to questions. I see we do have some questions, so we'll try and get to those questions in a minute. Just before we do that, I just want to say a few words about fund domiciliation and the much neglected and perhaps even misunderstood area about independent fund director selection too. First of all, on the subject of the international fund jurisdictions, I'm sure most people following this today will know this, but the key to domicile selection are your existing and your prospective investors and what it is in particular that they want. Unless you are, as a manager, focusing upon the large public pension funds, particularly in multiple major markets, then you do not need to be domiciled in the European Union, those top two jurisdictions on this slide here, unless you particularly really want to. A lot of US managers use private placement, which means that you can go to Guernsey or Jersey. Fewer and fewer of them are using the jurisdictions in the Caribbean or Bermuda in comparison with what they were doing in the past. But certainly private placement, if you're an alternative manager looking to come into certain markets, is a very well-trodden path and is very much worth investigating, unless you have a particular reason. And you indeed might. There are investors, big public pension funds, including in markets that are very familiar and used to using private placement in the Nordic region and in the Netherlands, for example, that would still prefer you to be domiciled in the EU. And fair enough if you are in that category. But as I said earlier, there's not necessarily all that many managers who are going to be playing in that sandpit. So if you're not, then you have a wider range of domicile selection choices in terms of your domiciles. So that is the latest AU assets for the pretty much all the global jurisdictions that you might be looking at. I would emphasize what I just said, that the ones in the Western Hemisphere are being used less and less by managers for the European market. Great if you're in Cayman and you want for the US and for the Asia Pacific region and indeed for the Gulf, but it may be an issue depending on who you're talking to here in Europe as an investor, potentially using Cayman in the way that it perhaps wasn't in the past. Bermuda and BVI are used less and less and less by investors over here. And there you have the two Channel Island jurisdictions at the bottom. I see Jersey's now getting to become quite a lot bigger than Guernsey, and that's a relatively recent development. I think they were closer to each other in the past than they perhaps are today in terms of assets. Moving on to the subject of fund directors, finding, in our view, finding independent or non-executive directors for your fund is often where managers will spend the least time when setting up their funds overseas. And that particularly applies to US managers who are coming at this from a partnership background in the States, which many of them are, or indeed managers that have maybe selected and had funds in Cayman for a long time. It really is worth making the point that a good fund director costs you little more than a poor one, and a good fund director can make a lot of difference as a sort of management consultant to your fund if he or she has the right experience and contacts. It's not, in our view, an area where managers should be looking to save money because the sums are so insignificantly different between good and bad. If you want to save money on your lawyers or on your travel expenses or whatever it may be, but don't try and nick a few $1,000s off the bottom line by getting the cheapest directors you can find who will just sign the documents and not ask any difficult questions. That I don't think is a good economy. Some US managers take that approach in Cayman. Many do not. They pick very good directors for their Cayman funds as well, but some do take that approach in Cayman. But it's less advised if you are in that category to do that if you're going to be selecting directors for a fund in either the, say, the Channel Islands, where they have very good directors, by the way, or in Ireland or Luxembourg. And by the way, we have been publishing a fund governance publication called the NED for, I think it's 13 years now. I've been losing count on how many years we've been doing it. And we would claim to know an awful lot about fund directors and fund director selection. And as you can imagine, we've got many stories to tell on that particular subject. So that as a broad opening salvo is all I really probably want to say today. Samantha, if you can, maybe we can go back onto the main screen and see what the questions are that we've got in today, and I'll try and answer these, and so we're all wrapped up by the top of the hour.
Yes. Okay. So the first question we have is, can you comment on using reverse solicitation to access European investors? We are a small-ish manager, and this might be best for us.
Yes, that is something that we will get into when we do domiciliation and distribution in more detail. The most important thing to be saying about reverse solicitation is, of course, it's not a marketing strategy, as many people know, but it's US managers in particular still use it a lot. It's a dangerous thing to do. You can get into trouble if it goes wrong, but I haven't really got any examples of where that has happened, but is potentially always hanging over that particular way of doing things. If you're a smaller fund and you're going to be looking at picking just one or two investors to start with in Europe, and you have a very good lawyer who can make sure that the legals are all tied up, then fair enough, fine, but it's not a long-term solution. Since the European Cross-Border Distribution Directive came in, becoming more difficult to do under the pre-marketing rules in that particular directive. But if you're starting up and you haven't done anything before, it's certainly worth considering. But bear in mind that you can find yourself in trouble legally, and there are some very tough legal penalties if you get it wrong. And indeed, if the fund goes all wrong, goes pear-shaped, and the investor can prove he or she was missold something, you are liable to give their money to them back. So it's potentially dangerous, but a very good lawyer, and most American managers do have very good lawyers, will hopefully avoid those pitfalls from happening for you. So that's that one. What was other questions you have?
And so the second question we have is, what are the main functions that the Manco performs?
What are the main functions that the Manco performs?
Mhm.
Gosh, how long have we got? Okay, very quickly, in summary, the Manco is the local management company, and another way around of saying the same thing is that they do everything so you need to do in the jurisdiction where you're domiciled, so you can get on with what you're good at, which is the portfolio management. And this brings up a very important point, which I didn't touch upon, including the risk management. Now, we can talk a lot about that. We have on our website, you can go and listen to a very good, although I say myself, podcast of a few of us, including one of the leading Mancos, Waystone, talking about risk management, what they do as a Manco. This is a subject that's of interest to you. But risk management has to be done in the jurisdiction where the fund is domiciled, if you're in the EU, and that Manco will do that for you. But it also does a whole host of other things. It looks after all the regulatory side of the fund, and indeed in Ireland and in Luxembourg, the regulator can turn up for a spot inspection, basically no notice. It can be, and I've heard of situations where it has been done, it can be a bit scary. So you do need to have a management company in place, whether it's your own or third party, that can satisfy the regulator, or you will get potentially closed down. The other thing they do very quickly, some of them do it a lot better than others, but they all nowadays claim to be able to do it, is distribution. They can help with distribution. Again, this is a subject we will get into at one of these future discussions.
Right, so the third question is, we have seen some very different fees quoted for management company services. Why is this?
Yes, that's a very fair question and very true. I've heard that many, many times. Why is this? I think it's because the entities that are doing, the main entities that are providing Manco services, come at this business from different places. There are those that come at it from the governance side. Waystone used to be, DMS used to be a firm that just did governance and basically became the largest entity in Waystone, along with two others that joined it. So they came from that angle. Other firms come from Autonomous will come from the fund administration side, et cetera, Each one of them comes at it from a slightly different angle. And I think particularly until recently, if not indeed now too, they will discount one side of their offering in order to get the business in another area. So they will include it. So if you're comparing the services for one particular entity, you'll see something very different from another entity because that entity is trying to get your business for another area, if that makes sense. But there's also a separate point. There is a lot that's left up to negotiation. There are some Mancos that just have fixed fees, and there are mostly, though, ones that do have a fixed fee and they derive the rest of their revenue as on a basis points deal on the AUM. A lot is left up to negotiation. If you're a big prestigious manager, you've got a lot of clout. If you're not, you don't. But it is definitely the case, as that person asked in that question, there is a lot of variation in the fee levels. Perhaps less so than there used to be, but there is still some today.
Okay, so our final question is, can we use our Cayman fund for European investors?
There's a lot of, it depends in the answer to that question. It depends, of course, on what type of investors you are going after, which markets you're going to, and so on and so forth. So it's not a yes or a no answer. Certainly, a lot of US managers, presumably that I bet that's the US managers asked that question. Most US managers, many US managers will have Cayman funds, and there's no reason why, depending on what areas of the European market they're looking at getting into, they should start with their Cayman fund. If they need to do something in Europe, they can do that later. So in theory, yes. Of course, my points earlier with regard to public pension funds would apply. It's much more difficult than it used to be. to use to invest in some of these Western Hemisphere Caribbean jurisdictions. I was mentioning earlier on, I remember going up to the Swedens and the Finlands and the Denmarks and the Netherlands back in the 1990s, and pretty much all of them will be investing in funds in Cayman back then, in the big public pension funds. But a lot has changed since then. And so if you're off that market, the answer is probably not. But if you're into private banking world, or if you're into certain specific individual markets in Europe in certain sectors, the answer is probably yes. Those are all the 4 questions we've had today?
Yes, those are the 4 we've had. Yeah.
Well, I guess, is there, I see another question. Do I see another question coming in right now?
One more, hang on.
So I see another number if we...
From Lavin, family offices are a bit more flexible and can invest into Cayman funds. Pensions from Europe, rather not. Right,
very fair point. Thank you, Lavin. And also, thank you all from around the world who are following us. I know there's a lot of people in the States who are with us today. And as Samantha said, there's people from various European markets joining us here today too. We will be doing, as I said, several more of these as the year progresses. And hopefully, once we get the results of our research out, potentially something in person in New York as well. So again, thank you very much. Thank you, Lavin, too, if you're following us there. For being with us today, and hopefully see you the next time. Bye-bye.
Bye.